Colorado voters will decide the fate of 13 constitutional amendments and initiatives, and that number does not include issues being voted on by individual cities and counties. And one of the statewide issues, Amendment 74, is being opposed by a growing list of political leaders, including Denver Mayor Michael Hancock. If passed, it would change the state constitution to require people be compensated if any law or regulation hurts their property values. And while it's widely believed to be a response to oil and gas laws, opponents argue the language is too broad and would up the developments in red tape. Mayor Hancock also announced he wants voters to say no to Proposition 112, which would require new oil and gas wells to be at least 2,500 feet away from homes and schools. And then there is Proposition 111, another issue all Colorado voters will be voting on. The payday loan bill, which would restrict charges on payday loans to a yearly rate of 36% and eliminate all other finance charges and fees associated with payday lending. Well, joining us to talk about Prop 111 is lawyer T.A. Taylor Hunt. So thank you so much for being here. I know you want to see Prop 111 pass, but many people see these payday places as an opportunity to get money right away when they're in a desperate situation.
Well, I mean, that is generally the public perception, but what we found is that particularly in the states that we look at that have reduced the limits or have just eliminated payday loans altogether, people do find alternatives. They use credit cards, they may borrow from family and friends, and they're taking more advantage of small installment loans. There are many more credit unions that are offering small installment loans, which can be $300, $500, which is generally the amount that people receive when they go to a payday lender. Even
with people who have lousy credit?
Well, that's where the credit union membership comes in, because credit unions have an expansive membership capacity, if you will, and they've even expanded to just covering a community instead of just, say, a particular employer. And so they are now moving towards giving more of those type of loans, being less restrictive in terms of the general FICO credit scores. But what we've seen is that people are very resourceful, because payday lending is fundamentally an issue concerning the disparity between income and expenses. And people are finding other ways. They really are accessing alternative sources, and that can be sometimes savings accounts, sometimes borrowing from an employer, mostly borrowing from family and friends. And we don't find this one ideal, but people are also making better use of pawn shops, so they have a chance to get their property back when things are doing better for them.
So why 36%? I mean, why not 20%?
Well, actually, what we would really like is to ban payday lending altogether. But 36% is a number that mirrors what the federal government put in place for military people. So our point is, if 36% is considered viable for military and payday loans still exist, and it was a readiness issue that led to that, then if we can begin with 36% for everyone, then we can move towards reducing it or ultimately eliminating payday loans.
This could put payday businesses out of business.
Well, I mean, that's part of their argument, but again, in the states that have gone to 36%, and there are some states that have gone lower, some are at 28%. Payday lenders have not just rolled up stakes and moved entirely out of the community, but that is part of the scare tactic, and they're very good at, when we are at the legislature, bringing their employees down to speak about how devastating things will be. But if you really think about it, there was a time in Colorado when payday loans didn't exist. But now we act as though they've always been here, and people didn't have any opportunity to take other measures. And it also means that communities, community banks, community associations have not had to step up and take responsibility for other community members by finding these alternative lending opportunities.
Because this would take away choices for people. I mean, ultimately, yes?
Well,
when they need money right now.
But if they need money right now, that may be short-term. That is short-term. It's a short-term emergency, and it's a genuine emergency. We don't discount that at all. What we're talking about is making sure that people understand the distinction between present law, which will result in an annual interest rate of 215% versus 36%. So if you're borrowing now at 215%, you have that short-term goal, and because they have the ability to deduct this straight from your paycheck, then you're going to have the long-term harm of next payday not maybe being able to pay your rent, not being able to meet your utilities, and then you're on that vicious cycle of potentially having utilities shut off, losing a place to live, which in Colorado right now, if you lose where you are currently living, it's almost impossible for you to find a way out.
You had mentioned that Colorado has tried this before and it failed, so we will see what happens in November on Proposition 111. Thank you so much.
Thank you.
Thanks for explaining. If you have a question or a segment idea, you can tweet us at Denver 7 Politics. And don't forget, you can watch today's segments anytime at thedenverchannel.com/Politics Unplugged. Thank you so much for watching. We will see you back here next Sunday for another edition of Politics Unplugged.